Right. So this is where we ended the last day that we are recording this meeting. Right. Yeah. Okay. So that you have to understand that value investing. Anytime you're following this kind of a philosophy, where so what is meant here really is that anytime you're following this kind of a philosophy where you're implicitly applying the price versus fair value paradigm, it means you look at a market price and then you say, well, this market price doesn't make any sense. It's according to me, the fair value is like you might look at something like Tesla and say that, well, this market price of Tesla is 734. This is not correct. According to me, the fair value of Tesla is $2,000, and so therefore you buy it here in the hope that it goes to that assessment of fair value that you have made. So anytime you're doing this, in general terms, you are engaged in value investing. So generally, we do this only from the long side, but in a broader, more general perception, conceptualization of this idea, you could even include the long short, even the short side of it. So anytime you're trying to compare price to fair value, making an assumption that price will eventually move to fair value, this is the critical assumption in value investing. One of the important critical assumptions that the price will eventually move to fair value, right? As one of your colleagues pointed out the other day, when I asked about one of the assumptions, that this basically the assumption is that this will move to fair value. So anytime you're doing that, you're engaged in value investing. That's why I said that, although we discuss it normally in the context of equities, but even somebody like Howard Marks, who's a debt investor, is actually also a value investor. And you look at the Howard Marks memos, and there's a lot of Howard Marks material on YouTube, lots of his lectures. You should listen to those as well. You'll see that he basically talks on the same kind of, he sounds very similar to Ben Graham, actually. He sounds very similar to Ben Graham, except that he's talking about debt and not about equities. That's not where he invests. He invests in debt, not in equities. Yeah, so experts, we talked about, yeah, this is the diversification where we discussed the diversification approach. So we can go here. All right, so we'll continue on from there. Okay, so let's look at this page. So the next point I want to talk about is we're going to have a little discussion on YTM. Once again, to make sure that your basic concepts are clear. As we discovered, many of you did not remember some of the important aspects of the CAPM, the model, cost of equity model, even the Gordon growth model. These are all basic things that were taught to you in the first year. So one of the roles that I have, one of the things I would like to do in my course is also basically keep you on your toes and keep quizzing you on the basic concepts so that your basics of your fundamentals are clear. Okay, that is one of the goals we have as we take you into the interview process, that your fundamentals should be clear. So let's look at this this point on page 22 that we are following. Okay, here he's talking about that did not follow this approach means this guy is talking about concentration and not diversification. And he's basically a believer in concentration, and you will see Buffett also is a big believer in concentration. So he's talking about what he wants to do and basically about discipline. That discipline is more important than some kind of technical skill. All these ideas you'll find that Buffett is repeating them as well. If you listen to, there's a lot of material on YouTube where during the Berkshire Hathaway AGM, Buffett and Charlie Munger, his partner, his investment partner, these guys are giving lectures on various things like how finance should be taught in business schools and what should be the approach to investing and all that. So generally educating the public, and you'll find that they basically repeat the ideas in this book. And so yeah, okay, so measure, quantify, etc. How much, we talked about that, how much, and we talked also about how much. Again, this is very much a value investing perspective. If you are a growth investor, then you don't normally ask how much. You talk about, because many people might already feel that Tesla is overvalued at this price. Okay? Many people might feel that. So, but People still want to invest in Tesla. People like Kathy Wood, who got Tesla right, they still want to invest in Tesla because they think it's going even higher. But if you look at Tesla's valuations, it's actually quite high. If you look at, like, I'll just show you this. So if you put this thing in context, how much, I think we should make a note about this also. How much, yeah, we haven't made a note about this. I want to make this a topic. I have a revision on YTM, but before that, we have this question of how much, right? So how much, question mark, question is more. So he talks about this obviously because this is a book on how much is always relevant in the sense that what we saw the other day when we did some calculations where we looked at your entry price and the return is affected by the entry price. Okay, so if I change this entry price here, I got entry price is 65, and if I change the entry price to, let's say, 85, see what happens to my return. It goes down from 53 to 18, right? So obviously entry price is always relevant just from a purely mathematical point of view, but even at 17 you're making a return, and this exit price could also be higher than this. So the point is that what we have to understand again as we read this book, although we are using this book as a text, but the reason I'm annotating it in this manner is that this book gives you a very narrow perspective on investing, and that is the value investor's perspective, which means it's the kind of a contrarian or mean reversion perspective on investing, and it totally ignores and disparages the momentum approach, which is not correct actually, because even the momentum approach, as I showed you, if you looked at Google for in the post-pandemic stage, the movement of Google, there's a lot of money to be made even as a momentum investor. So we should not disparage that approach. Eventually, you can choose whatever suits you, but you should be conscious that both are legitimate approaches, which you would not get. You would not get that perspective if you read this book. If you read the book only without any annotations, you will think that this is the only way to invest. That's not really correct. Okay? So many people like Kathy Wood has been very successful as an investor for the last 2-3 years, and their assets under management have grown tremendously because they are all growth investors. They are all big picture growth investors. So it's not true that this is the only way to invest. Okay, so that's how I just want to make that note. The question is more relevant for value investors, not so much for growth investors. Okay, so in equity investing, we have these two major themes. One is value and one is growth. So value investors would typically go for prices which are kind of much lower, beaten down, below price, quite low price to book and things like that. So that would be the kind of approach. Whereas growth investors look at where the growth is. So Tesla is a classic example of a growth stock. If you look at the trading price earnings ratio, the TTM, the trading 12 months price earnings ratio, which means current price divided by the earnings over the past 12 months. If you look at the PE ratio of Tesla, it's quite almost ridiculous because it's so high. It's 386. The normal PE ratio for the S&P 500 typically is around 16 or something like that. So this one, the PE ratio is 387, right? So you can see how people would say typically that this stock is overvalued. You take a value investor's perspective, but there are still people willing to invest in this because greater potential. So this how much needs to be understood properly. That it's more relevant if you have a value investing approach and not so much if you have a momentum investing. So value investing is mean reversion approach, and growth investors are actually more aligned with momentum investors. Okay, so although growth investor would typically be a fundamental analysis kind of person, whereas momentum investor is more likely to be a technically oriented person, a technical analysis oriented person, To some extent, they're also FA oriented, because you can say growth investing is really about earnings momentum. Okay, but momentum investing fits more easily into technical analysis. It's much easier to demonstrate momentum strategies with respect to technicals. So, but again, as I said, growth investing is about earnings momentum. So it's not really that you can't apply it to FA also. So you have to understand this point about how much. It needs to be taken with a grain of salt. If you're following growth investing, you can still invest in a company with a 387 P ratio, and and you see that they're not paying any dividends. Okay, there is no dividend here. All right, so still people are investing in Tesla, and you can check for yourself what actually happens. This may eventually still go up higher than this. So you have to understand. So that's one point to qualify about that. That not so much for growth investors. The how much question is not so relevant. Okay, now let's look at another one. He's talking about again how much, and again you notice that this is a traditional investing, traditional asset management kind of approach, value investing, because, or we'll call it TAM, or traditional asset management, because you can see question. He is comparing the return on bonds. Okay, he's comparing the return on bonds. Now, look at this statement. I want to just make a comment about this and take you into a discussion on yield to maturity, YTM. He's used the expression yield obtainable. Yield obtainable. Now let's look at the statement, right? So he talked about 9.4 in 1970. Now it's come down to 7.3. Now he's saying, so let's go on to the next page a little bit and see what he's saying there. Look at this. Okay. So he's saying that high-grade public utility bonds are yielding 7.3%, and he's saying yield is obtainable. Okay, so the question, therefore, he's saying is that you should what kind of return should we expect on stocks? Well, the first benchmark is how much are we getting on bonds, on high-grade bonds, and the answer here is 77.3%. And let's see. Okay, so we'll come to this page 23 later on. Let's look at this now. This statement, the yield obtainable on new offerings of high-grade public utility bonds is 7.3%. Okay, now if you look at it, what is the problem with this statement? If you look at any, if you look at this kind of a treasury, actually Bloomberg has a better, let me try and get a better. I'm opening the Treasury, US Treasury homepage, right? And when I say when he's saying yield obtainable, we can look at the yield on government bonds as well, right? So you can see the why has only one come up? Usually they look at oh, okay, because the month has just started, so only one has come up. Okay, and we don't get a good. We don't look at. Let's look at this. Okay, just one second. Let's look at this. Yeah. Okay. So let's look at. So here we don't have good. The app here doesn't work on my browser because I think it requires Flash. Let's look at these bond yields. Okay. Now this is typically when you look at bond market returns. This is typically how you look at it. Okay. Let me just copy this into your thing here as well. So this will fill out as September goes on, but there's only one day done in September right now. So this is fine. We can actually. Now let's look at this. Okay, 10-year government bonds in the Americas. Here you have Canada, Brazil, Mexico, US. So look at the 10-year government bond yields. So you have this. These are the rates. Okay. Now here what he's talking. Well, let's just take this 1.3%. Okay. Now this 1.3%. What does this mean? Does this mean that my question is, what is the problem with saying that? Is this, my question is this yield really obtainable? When you see the YTM, okay, when this guy is talking about this here, he's looking at, when he's looking at high grade public utility bonds, it's 7.3. He's looking at a page like this where the bond yields are given. Okay, now these yields, this is how bond markets are tracked. Okay, when you look at bond markets, you usually look at the yields. You don't look at the prices of bonds. You look at the yields, and these are the YTMs. So whenever you see a bond yield chart given like this, you will know that these are the YTMs. Okay, so what is my question is? My question is that this statement that is this yield really obtainable over 10 years? Because the U.S. government is not going to default, we assume. Does anybody have a view on this? What is my question? What am I trying to ask here? Is this really obtainable?
Sir, now it is not obtainable. What it is written in the book of 7.6%. Because as we can see, yield is now only 1.3%, and I think in USA, I think it's 4 or 5% is the inflation rate only. So obviously, that would be like losing the money.
No. Let me reframe the question. No, I got what you're saying. That's fine. Obviously, that is different from this. Okay, but I'm just asking you, if I look at this chart, let's say I'm teaching the class and I'm looking at this chart, and I tell you that, look, this is the yield on this is the YTM on 10-year government bonds, and so United States 10-year government bonds, these are actually called treasury notes technically. If I say that, oh, look at it, this is 1.3%, that means that you can obtain a yield of 1.3% guaranteed over 10 years on US government securities, US Treasury securities. Now, is that statement correct? That am I guaranteed, because the US assume here that the US government is not going to default. Okay, so that all your monies will be paid over 10 years. But what is the other problem with assuming that it is obtainable? Is it actually obtainable? Obtainable in the sense, is it guaranteed? Sir. Why is it not guaranteed?
Because in USA, the bond prices are also changing. So that is a yield. But in yield to maturity, when we will be seeing, so it can be lesser also, it can be more also, depending upon the price of the bond.
No, price, I assume that we are holding it to maturity. Okay, so you assume that, first of all, that investor, I'm just making sure that your basics are all clear about YTM. First of all, when we say YTM, this is what we mean. Whenever you go and track bonds anywhere in the world, you will be typically tracking the bond market yields. You will not be tracking the bond prices. You will be tracking bond market yields. As you can see here, different yields in different countries. Canada is closer to the US. These are both developed countries. 10-year Canada yield is lower than US. Now, typically you will be looking at this. Now, what I was saying to you is, I got a little lost as to what I was going to ask you. So investor holds it to maturity. So first thing we assume in the case, so whenever you look at bond markets, you will always get used to this kind of display, because whenever you look at bond markets, you will always be looking at this kind of a display. There will be some mention about the maturity. Otherwise, they might do is they might just go to the United States. I think if you go here, you will see. You can see another way of displaying it is like this. You look at this column, okay, column 4. This is the yield, this is the YTM. Okay, there you can see a little bit of a change from 1.3, 1.3 to 9. Okay, so the updation rate times may be different. Okay, so you can see the treasury. Now here what we are doing is we are just looking at US markets, okay, US treasury markets. US Treasury debt securities. Look at them, 3-month. This is how you will be looking at. This is the yield curve that you'll be looking at. Okay, so this is your column. This column is the yield. Then you have the different maturities. Okay, 3 months, 6 months, 12 months, etc. 2-year, 5-year, 10-year, 30-year, and you will see this. So this is how you look at bond markets now. So this is the yield or the YTM. You will always be looking at the YTMs, like you saw in the previous display for different countries, Brazil, Mexico, and all these people. Now, all these countries. Now, my question is, so this YTM, you have to have a good understanding of what it means, okay? That's why we are spending so much time on it now. So the first assumption here, you're going to make the assumption is that the investor holds the debt to maturity. So the first point that Mayank was raising, now I have removed that problem because I'm assuming, so what Mayank is talking about is that it's a 10-year bond, but it's a 10-year debt security. So in between, if you want to sell it after 7 years, you may or may not have a loss or a gain on the price component. Like remember, we mentioned price variation as one component of the return. Sorry, this is the yield. Okay, one component of the return is, this is the coupon. Now, this is one component of the yield is price variation. So if you are holding a 10-year security and you want to sell it after 7 years, there may be a loss on the price component. So therefore, you have you can have a loss. Okay, you may not realize the 1.29% that you see right now. Okay, so that's one part. Okay, so are you satisfied, man? You were talking about this. Now, if we assume this, are you satisfied that
Yes.
you will not have a price loss because we are holding the debt to maturity and we are looking at treasury securities so that we know that there is no risk of default. Okay. Generally there is no risk of default, although we did have in 1998, I think we had 97 or 98, I'm not sure, late 97 or 98. We had the Asian financial crisis. Before that, just before that, we had the Russian default. So actually there, the government of Russia defaulted on its own Russian ruble denominated debt security. This is like the Indian government defaulting on rupee denominated debt, government debt. Okay, this has never happened here in India, but it happened in Russia. So, but in general, we consider this not to, we assume that this will not happen, that no country will default on its own, on debt which is denominated in its own currency. But the Russians did, huh? You have to remember that in 1998, the Russian default, that was on ruble denominated government debt, which was a pretty unusual event. And that caused the collapse of LTCM. The LTCM collapse is mentioned in this book. Okay, the Russian default is in 1998. That's the event that caused the eventual collapse of LTCM. So you have to remember that. But in general, we assume that this will not. There will be no default on the principal or the interest payments on government securities. So now, to address Mayank's first question, we have made an assumption that we hold the debt to maturity. But I'm still saying, even if you hold the debt to maturity, by yield obtainable, I mean obtainable means it's definitely obtainable. Okay, nothing can stop me from getting it. Is that statement correct? What is the other problem with this statement? Even if I assume that we hold the debt to maturity. So the first problem that Mayank has raised, I have removed that problem by making that assumption. But I'm still asking, is there still a problem with that statement? What else could tax rate? Yeah, tax rate is because tax rate we know in advance. We assume there are no changes in the tax rate because at this point, fine, in 10 years tax rates could change. But again, that's another thing we assume is that taxes remain the same. Okay, no changes in tax rates. We assume that. Okay. Although tax rates could change, as you saw in 2018, the US did a major tax reform legislation, which now may be rolled back depending on what the Democrats can push through Congress. Some of that may get rolled back, but there were some major changes in the US tax system in 2018. But we assume that there are no changes in tax rates also. What else? Anything else important that you studied in your first year in YTM? Is my question clear? I'm questioning this statement. The yield is obtainable. Obtainable means it's definitely obtainable, which means nothing can stand in the way of my capturing this return. and this statement has been made in this book. The yield obtainable on new offerings of high-grade public utility bonds. Where did he get this figure from? He went at that time, he went to a page like Bloomberg, okay, where you can see various US bond rates. You see United States rates and bonds. Okay, maybe I should put this also in there. Right. So yeah. So how did he get that rate of 7.3? He would have gone to a page like this, where different types of yields are listed: treasury yields, then TIPS. There's inflation protected securities. These are basically you'll see the yield is lower than the yield on the normal security. We have this in India as well, but it's not very actively traded. These are actually inflation protected, means if you buy this and inflation goes up, you get compensated. Okay, so your principal is blown up. Your principal is blown up means in the sense it's increased so that you can get the same, as if there was no inflation, you get the same return. So basically, you get fully protected against inflation. But the market is not liquid because our bond market itself is not well developed because it's over-regulated. Like pretty much everything in India is it's over-regulated. So, but the US market is pretty active in TIPS. So that's another type of security. You can go to the TIP web page here and read on TIPS, the US Treasury web page. You will find information on TIPS. Even if you look around, you will find information on TIPS if you want to learn about how these are priced. So, but how would this guy have got the statement, this figure 7.3, coming back to our problem? I just wanted to educate you on TIPS also. Let's look at this. So he would have gone to something like that. Then he would have gone to some categories like they haven't given any corporate bonds. Let's just look at muni bonds, okay? So let's assume that these are that's a muni bond rate. So you have gone to the muni bond page and looked at, okay, 10-year muni bonds, 0.94%. Okay, these are actually tax-free. That's why the rates are lower. Okay, so these are 0.94. Okay, it's a tax-free rate. So it's not really comparable to what he's talking about. But he would have gone to something like this, and he would have looked at the yield to maturity, okay, the YTM, the yield on these types of bonds, and then he would have said, okay, see, we can get 7.3%. That's how you'd have got this number. This is how bond markets are discussed in terms of the current yield to maturity. And typically, you have to always be careful in the case of bond markets. You always have to look at what is the tenor. If you're talking about 1 year, the rate is different. 5 years, the rate is different. So you must always keep an eye fixed on the tenor that you're talking about. If you're talking about interest rates, you must always talk about the tenor as well, because without the tenor, it doesn't make any sense. If I just tell you that I got 6% on an Axis Bank fixed deposit, that statement is not really complete, because the next question you're going to ask me is, what is the period of the fixed deposit, right? Because 6% I could earn overnight, or I could earn in 3 months, or I could earn in 1 month, or I could earn in 10 years. So what is the tenor? So for bond market, debt securities, the interest rates on debt securities, any interest rate discussion, you have to always bring in the maturity, because if you change the maturity, the rates will change. So this guy would have gone to one of these and got this rate. Now these are the YTMs that are shown like this. So what is the problem with the statement? Yield obtainable. If you just look at this and look at the YTM and then say that this yield is obtainable, what is the problem with that statement? We have removed two problems raised by your batchmates. One is the investor, the interim price risk. If you sell it before maturity, we remove that problem by saying that we're going to hold the debt to maturity. Then tax rates, changes in tax rates, we assume no changes in tax rates. Because current tax rates you already know, so you can figure out the after-tax return right now. But we assume that there are no changes that are going to happen in tax rates as well. Okay. So now, so what else? Anything else that still remains as a problem? Why this yield may not be obtainable? Yes, spending a lot of time on it, but it's important to understand. Yes? Anybody? Okay. So now let's look at what the YTM is, okay? Now let's first go into then let's go into a discussion of what is YTM. How would you define the YTM? Where have I gone? Yeah, we'll come to that. Let's bring this picture here. Okay. Yeah, this is the YTM, right? But how would you? So I've given for your benefit. I'm giving you the YTM. All right. Now, what is this? So let's just look at this one. Let's say. Okay. So here you have the face value of the bond is $1,000, right? The coupons are 4%. It's a 4% bond. Let's assume it's paying once a year, annual coupons, just to make it simple, so that we don't have to adjust the semi-annual rate of interest and all that. So annual coupons, $1,000 the face value of the bond, and the YTM, that is the market interest rate. Okay, the YTM is the market interest rate. As you can see here, this is what you'll get, the market interest rate at any point of time. And this market interest rate obviously moves around. If you look at here, if you look at the US 10-year security, so you can see how the 10-year yield that you looked at in here, this page, this 10-year, maybe we can make it a little bigger. You can see it a little better. Yeah, you see this 10-year yield of US Treasuries. Now it's 1.25, but this is just a point in time capture, right? This is the yield today. But if you wanted to know how has this 1.25, you see here it should be roughly the same. I don't know, there may be this, they have not updated the rate. This is the they have not updated because the US markets are closed. It's actually based on an index, CBOE index, right? So they've not updated. So in overnight trading after the market close, the US market must have, bond markets actually must have, where is the yield now? From 1.3 here, and this has gone to 1.25. So bond prices must have moved up actually. That's why the yield is lower. Okay? This is more currently updated. So 1.25. If you want to know how it has moved over the different periods, here you can see. You can see here. You can see the data from 1964. Okay, so this is the movement of the yield. So this 10-year rate for US Treasury borrowing, this moves around like this. Okay, so this is how you track the market movement. Now, so this is the market interest rate. This YTM is the market interest rate. So if you wanted to explain this to me now, if I ask you as a let's say you're my financial advisor and I'm an investor, and I ask you this, what is this YTM stuff that they keep quoting in the newspaper? So what would you say to me? How would you explain it to me? Anybody? Yes. Who should we ask?
Sir, can you repeat the question?
Yeah. So question is that I want an intuitive definition of YTM. That is, what is YTM in the sense that suppose I'm an investor and you're my financial advisor, and I'm looking at all these YTM figures in the newspapers or on the financial websites. The YTM for 10-year US Treasuries is 1.25. And so I'm just confused, like, what does this YTM mean? How would you explain YTM to me intuitively? What is it? And if I maybe even see this kind of a formula, then how would you explain it to me? What is YTM? Right? Let's, yeah.
Basically, the interest rate that we will be getting on a bond if we hold it to the maturity.
Okay. Is that statement correct? Now, this is basically you're coming back to the same question that I'm asking. That I'm saying that what I'm saying is that what you just said, you're repeating kind of like indirectly, you're repeating what Graham is saying in this book here. Because Graham is looking at the YTM charts, the YTM tables, and a little after June 1971 maybe, he's looking at the YTM tables just like we were looking at them here today. He's looking at these tables and he finds that high-grade public utility bonds, so let's say these are AAA rated bonds, highly rated corporate bonds, like the equivalent of investing in, say, Hindustan Lever or debt securities, commercial paper of Hindustan Lever or ITC, highly cash-rich Procter and Gamble, highly cash-rich kind of companies, so very low credit risk. So these high-grade corporate debt he looks at the YTM of 7.3% and he says this is the yield obtainable. So essentially, Mayank is repeating the same thing, okay? But now brings me back to my same question that what is the problem with this statement? That is it really obtainable? There is one assumption that we are not discussing yet. That's why I wanted to bring you down to starting with the basics of YTM. What is YTM?
Reinvesting the coupons we receive annually.
Yeah, so reinvesting the coupons where? At what rate?
Similar prices.
Similar prices. 1 minute. What do you mean by similar prices?
The one to the securities which is offering a similar rate of interest like YTM.
Okay, but it's close, but it's still not perfect. Okay, so what I want to hear is, let me take this. We have this picture pasted everywhere, and I forgot to paste the source. Okay, so that is should be taken as not plagiarism, but I forgot to paste the source. I pasted it the first time. Where are we? We are talking about the YTM. Okay, now let's go back to this and paste this picture once again, because it just helps us to discuss what is YTM. Now, first, let's understand what is YTM. Okay, so the way we should define YTM is, we have tried to define YTM later also. Okay, so let's define it here, and then we'll take it back. What is YTM? How should we write YTM? YTM, we should understand YTM as, this is how we should intuitively understand it, that it's the discount rate. Remember, what we are doing here is that we are discounting the coupons. Like I said, the YTM is the market interest rate. Okay, and so this is like a 3-year security, right? This is a 4-year security. So first year, second year, third year, 4-year. So 4-year YTM is 3%, which means the 4-year interest rate is say 3%. Okay, the YTM on 4-year securities, preferably government securities, is or the rate for a security which has the same risk profile as this bond is 3%. Okay, so the YTM is 3%. So the YTM is actually a discount rate. Okay, it's an interest rate. You can say it's an interest rate. It's the discount rate which, when applied to the cash flows or the returns from a particular bond, okay, from a bond, produce a bond fair value which is equal to the market price. So remember this RHS part here. What is it actually? This is, remember, we had the long discussion on fair value. Okay, so we'll come to Isha's point later about the reinvestment rate. But first let's understand conceptually what YTM is. YTM is the interest rate, or in this case, the discount rate. So you can say that YTM is an interest rate, and it's the discount rate, okay, because we are discounting it. So we call it a discount rate. So the discount rate, which when applied to the returns from the bond, these are the returns, these are the coupon returns, coupon return, is the net yield component of the return. Well, actually the gross yield, because you have taken your financing. This is your financing cost actually. So this together is the net yield concept, and this is the gross yield. So you have discounted the gross yield and the gross price variation. In this case, there is some price variation because you're actually buying the bond at 1037 and you're getting 1000 back. So you're actually you're getting 1000 back because you're buying. So there is a loss of principal here because you're paying this much excess for the principal, 37 for $1,000, but you get back only $1,000, right? So there is a price variation loss here. So all the returns from the bond. So what is the YTM? The YTM is an interest rate, and in particular, it's the discount rate which, when applied to the which when used to discount the returns from the bond, okay, from the investment in the bond, including the coupon and the principal return redemption, produces a bond fair value. What is this RHS expression here? This is the fair value of the bond. Remember what we discussed? What is the general formula for fair value? Put the returns in the numerator for any asset, fair value for any asset. Remember that? Anybody wants to tell me what is the general framework that you will use to do the fair value for any asset? Yes.
So discounting the dividends, future
So don't say
dividends that we will be getting.
don't say dividends. Dividends is too specific. Say returns, because my question is in general terms for any asset. Dividends is only for stocks. So you have to get into this habit of talking in general terms when the specifics is not required. The specific reference is not required. You understand what I'm saying? You understand what I said about your answer, right? The question is in terms of general terms. So when I'm asking the general question about what is the general framework for doing the fair value calculation of any asset, so the answer to that is that returns. This is there in your notes also. If you go up there, you'll see it. It's there in your notes. Okay, but I don't want to waste time going up and down. But the general formula is that you take the returns from the asset in the numerator and you discount the returns, okay, at an appropriate discount rate, and then the sum of the present values. So there is one present value here, one present value here, one present value here. So this is the present value of the 3-year return. Okay, this is the present value of the 4-year return, and you add up all the present values just like you do in your project NPV, and then you get the fair value of the asset. Are you following now? Yes. What happens?
Yes, sir.
Yeah. So the general formula, always remember in general terms. Okay, the reason I corrected Mayank is he used the word dividend. Dividend is only for equities. But I was asking a general question about the general framework for asset valuation. It could be any kind of asset. Okay, right? It could be like what we discussed. HCL Tech has bought a bunch of licenses from IBM. Those are intellectual property assets. So they don't produce dividends, they produce royalties. But whether it's dividends or royalties, if you use the expression returns, then it covers everything. It covers bond coupons, it covers patent royalties, it covers stock dividends. You understand why I use the word returns? Because returns is more general. Okay, everything is covered in returns. So the general framework is put the returns in the numerator and discount them by the appropriate discount rate for the returns from the asset. And when you add up the present values, you get the fair value of the asset. You remember this now? We had the discussion earlier. Yes? Everybody's sleeping.
Yes, sir. So discount rate is the current market rate going in the market.
Yeah. So which we are using in the case of this bond, we are using the current market rate, which is given to us by the YTM. So we go and look up something like this, of course, because we are not paying for services. So we may not have access to all the different types of rates. But this is basically generally what you do, that you look at some kind of a market rate display for different types of debt securities, and you find out basically what are the different rates for different bonds. Okay, if we look at, I'm just trying to see if we get a better data set on CNBC. Maybe they'll cover, but pretty much everybody has the same kind of coverage. Okay, so you go here, you can again see the different, they all take the yield, right? So you're right that we take the by the yield to maturity. In the case of bond markets, we look at the yield to maturity. These are again different countries' government bonds. They haven't taken US corporate bonds. But this is basically the idea. We go to a sheet like this, a page like this, which gives the market rates, market interest rates, or the YTMs. Okay, these are the YTMs. This is how bond markets are always discussed in terms of the YTMs. So we look at that, the market interest rate, and we use that interest rate in the case of a bond. When we are doing the fair value of a bond, we discount the returns from the bond to the coupon returns here, and the fourth period you have coupon plus principal return. Okay, and we discount all of that by the appropriate discount rate, which is the YTM for the 4-year debt security of this same credit class. Okay, so now is everybody clear that this is the fair value? This RHS part of this equation is the fair value of the asset. Are you clear about that? Because this is our formula that we discussed. Yes or no? We have to ask.
Yes, sir. Clear.
Yeah, it's clear. Okay. So this is done. So don't forget this. Okay, it's a very general and it's fairly simple actually, and you already done it many times in your finance one, finance 1 and 2. But you just have to remember this as a general formulation that any asset that is being valued, if you just take the returns in each period and you discount it by the appropriate discount rate raised to the appropriate power, then you get a present value for that period's return. Then you get and you add up all the present values for all the different period returns, and then what you get is the fair value of the asset. Okay. So therefore, what is YTM? YTM is actually the interest rate, and in particular, it's the discount rate which, when it is applied to the returns from a bond, okay, it produces a fair value for the bond which is exactly equal to the market price of the bond, which is on the LHS side. That's why you see this equation. Okay, so let's write this somewhere. I'm trying to write this so that we have this definition also here with us. Right? So actually, I was going to write it lower down because I have another discussion of YTM. We'll write it here. Okay? YTM is, let's call it an interest rate, obviously. Okay. The discount rate. Now, don't memorize this, okay? But you can memorize key parts of it, but make sure you understand it. Before you memorize it, you have to understand it. Once you understand it, then you don't have to memorize it anyway, because you will be able to express it in your own language. You have to understand what it is actually. So YTM is the discount rate, a market interest rate. Okay, so in the sense it's an interest rate and it's an indication of a market rate. Okay, a market interest rate, the discount rate, which when used to now I'm not going to write in general terms like asset, etc., because YTM is a term that we use only in the context of bond markets. Okay, we only use this thing in the context of bond markets. So therefore, I'm not going to write this. Okay? I'm not going to write the. I'm not going to write asset in terms now, in general terms. And now I'm going to be talking about specific terms relating to the bond market, because YTM is only used in the context of bond market. It's a market interest rate. The discount rate, which when used to discount the, I can say, the returns, coupon plus principal. Okay. Okay. Repayment, but I'm trying to use a shorter word. Okay, coupon plus principal. What are the returns from the bond? Coupon and principal repayment. And again, you can bring in your general framework. What is coupon? Coupon is the gross yield, and principal repayment is the price variation component. Okay? So discount depending on where you bought the bond. The discount rate, which when used to discount the returns, okay, from a let's write this in debt security in more general terms. Okay? For debt security, produces a fair value for that Okay, so understand this now. Okay, so we can even repeat this here. YTM is a market interest rate, and when we say that, we can take this. These are all YTMs. What do we mean by a market interest rate? What do we mean by that? We mean that when you look at bond market levels, when people want to see, when people say, okay, show me what the bond market, how the bond market is looking, you typically show them something. How is the US Treasury bond market looking? okay, you would show them like this, something like this. You'd say, okay, look at this. 1 month is yielding, about 5 basis points. 5 years yielding 70 to 77 basis points. 30 years yielding about 2%. I see this is changing. Okay, so this is how you would describe bond markets. Okay, so it's the market interest rate. That's what we mean by that. Okay, so we can say that YTM is, to be very clear. Okay, so the YTM is the discount rate. Let's understand the key parts of the statement. Okay, please make sure you are paying attention. These are all basics of bond markets, and we can see once again that you're not clear about some of the basics. Okay, what are the key elements of this definition? Discount rate. Okay, it's a discount rate. So immediately you know that it's going to be involved in some kind of discounting calculation like what you see here. The discount rate. What else? Obviously, discount rate is going to be used to discount the returns on the bond, on the debt security. Okay, that's fine. I'm not going to highlight this because the whole point of having a discount rate is to discount some kind of return. Okay, so you're going to do that. Now produces a fair value. Okay, fair value. Now we should put this fair value in brackets, with an inverted commas, because that has a specific meaning. A fair value for that debt security. Okay. This is the important point. Now you remember when we first had the discussion about fair value, price versus value. We first had the discussion about price versus value. We made one thing very clear, that price and value are two very different things. Price is something you can observe in the market. Okay, the yields on this will correspond to a certain price. The yield of 1.3%, it corresponds to a certain price. Or if you take some other bond price, sometimes you get the prices of bonds available, and those are those are actually, so the price is very different from the fair value. So the price is clearly observable from the market and it's objective, whereas fair value is generally a subjective measure, which is different for each investor. Now, this will change a little bit for one bond market, but it will remain subjective, and that's where we come back to my question about what is the problem with this statement. Okay, so first understand what YTM is. It's that discount rate which, when used to discount the returns, produces a fair value, which is, it produces this. The RHS is equal to the LHS. So you choose this YTM or the discount rate in such a way that for the coupon that is presented to you, for the bond that is given to you to value or to analyze, the fair value of that bond becomes equal to the market price. Okay, so these are normally different concepts, price and value. They still remain different concepts, but in this particular case, they are the same. And how do they become the same? They become the same because you chose this discount rate in such a way. See, this is given to you. I gave you the security that you have to value, and the market price of the security is also known. Okay. Now, what is not known is the fair value of the security. So, in order to get a fair value, you need to have a discount rate. So, what did you do? You went on playing with different discount rates and doing the fair value of the bond on the RHS. You already know the LHS, the price, the market price. You can see what the market price is. So what did you do? You started playing around with different interest rates with one objective, that how can I produce a RHS value which is equal to the market price? I already know the market price, so I need to keep on. So if you maybe initially put like 1.05, okay, as you know, the price turns out to be 1037. So initially, if you put 5, then you get a fair value equal to 965. Well, that's too low actually, because the market price is 1037. Your goal is to produce a fair value RHS equal to the market price. So now 105 is too high. The rate is too high because the fair value is turning out to be too low. So what you do is you lower this discount rate, and you keep on doing this until you finally come out with a fair value which is equal to this, which is the market price. This you can observe in the market. So are you following this process now? Have you understood what YTM is? Okay. Now, in terms of that is if you did not have access to all this information. This is how this YTM is derived. How are these YTMs derived? They look at the market prices of the bonds. They look at this particular 10-year security. What are the coupons on the security? As you saw earlier in the previous display, I think in the previous display, if you remember, these are indices. Maybe I clicked twice. If you remember here, we saw straight went to. There was one intervening display where we actually saw only the coupons. We saw the coupons also separately. Anyway, doesn't mind. You know the coupons, right? So you know the coupons, and so you keep on doing this until you get a market, you get a fair value which is exactly equal to the market price. Okay, so this is has everyone understood this correctly? Is this clear now? What is the YTM? In practice, you will see this. In practice, you can see it from the any bond market pricing page. They will show you what the YTM is. But that's not good enough. You need to know conceptually how is this number derived. That is what I'm asking you. Conceptually, you have to know how did they arrive at this number, 125, for the 10-year yield YTM. Okay, this 1.3 you can see the previous closing price, which is why this charting application, which has not been updated because it's a CBOE, the US markets are not open. This is still showing 1.3, but now after opening, the bond prices have moved up, so the yields have gone down. But how is this arrived at? How did they arrive at this number? They looked at the market price of the bond. They looked at the market price of the bond. They looked at the coupons on the bond and the principal redemption on the bond. So they had the market price here. They knew the coupons. They knew the principal, but they did not know the YTM. How did they arrive at the YTM? They keep this left-hand side, this on one side as a benchmark, and they keep discounting the coupons and the principal repayment with using different interest rates until you get a fair value, which is the sum of all these present values, this plus this plus this plus this, the total fair value, which is exactly equal to the market price on the left. Okay, so you keep changing the discount rate. So is everyone clear now how YTM is derived? One minute. Where is this? All this. Where did I lost it now. Yeah. Maybe I should take this here also. Here. Now let's ask some people because it's looking like people are very confused. Let's ask Piyush Pant. Pant, have you understood this definition? It may seem very confused, but it should be fairly clear by now. I've explained it multiple times. Yes, Pant. What happened? Pant is sleeping.
Yes, sir. Present, sir.
You're present, but you're present, yes. But my question is, have you understood what I said? Have you understood what YTM is conceptually, how it is derived?
Yes, sir. Yield to maturity is the yield that we derive from a stock or a bond upon its maturity.
No, not stock and bond. No, we don't have yield to maturity for stocks. It's only for bonds. You can just say for debt securities.
Yes,
Generally bonds, but better to use the word debt security. There is no yield to maturity for stocks. No, my point is that have you understood now? I gave you a definition here and I showed you how it is derived. So this is the definition which is hitting on some key points that it's a discount rate which makes the fair value very simple. Discount rate which makes the fair value of the bond equal to the market price. Simple. Market price you can always observe for any secured asset which has a market. You can observe the market price, and in this case you know the coupons and principal repayment from the bond. You just, and how do you derive fair value? You derive fair value by taking the returns from an asset and discounting the period-wise returns, producing a fair value number for each period return, a present value number, and then you add up all the present values, and then you get the fair value of the asset, right? So that's what you do. For that, you need to do a present value, you need a discount rate, right? So it is the YTM, which is the discount rate. The YTM is derived by using discount rates repeatedly until the fair value, playing around with different discount rates until the fair value becomes exactly equal to the market price, which is observable. So that's the concept that I'm asking you. Is that concept clear, how it is derived, YTM?
Yes, sir.
Yeah, this clear? Okay, this is very important. Please make sure you understand this. It's recorded, so you should go play it back. These are basic concepts which you should be very clear about, okay? That once I should have got a pat answer from pretty much everyone when I asked you this question, because you already covered this. Now that's why I'm making sure that we are clear about our fundamentals. Okay, what is the YTM and how is the YTM derived? That's why you'll notice that the YTM in the Excel formula, you have to use Excel to get YTM or some kind of spreadsheet, because you can't do it algebraically. Other things you can do through algebra or some calculus or something. This one can't be done. It actually has to be done like this. We call this iterative approximation. There is no mathematical shortcut here. Okay? There is no analytic solution, as we say in mathematics. There is no analytic solution. So you have to literally go like this. Okay, left-hand side, I can see the market price for a 10-year, for a 4-year treasury note is 1037. Okay, that's fine. Keep it on one side. Now, this 4-year treasury security that you are giving me is showing a return of coupons of $40 every year, and then after 4 years it's paying 1040, the coupon plus the principal redemption of 1000. Okay, those are the returns for each period. So I first make the numerators for these periods. I write down the numerators. Then I find out. Then I start experimenting with discount rates, because in order to do a present value, I need a discount rate. I experiment with discount rates. I put 5, I put 6, and etc. But I keep on changing the discount rate until the fair value, which is the right-hand side, becomes equal to this market price of 1037. Please understand this clearly. This is the basic idea behind YTM. So you have to get YTM only by this method. You have to keep on experimenting. Plug in 5, plug in 6, plug in 7, plug in 4, not working, plug in 3, maybe now it's working. Okay, so that's how you do it. And there is no mathematical shortcut, so that's how a spreadsheet also does it. Okay? This is how you find out IRR or YTM. Okay, now we'll come to that other part about it. Now, what is the other problem that I wanted to ask you about? I still come back to this question. The problem with this statement: yield obtainable on new offerings looking at 7.3%. Okay, what is the problem with this statement? Now I'll just quickly wrap it up, because I've asked this question many times, so that we don't lose much more time. I'll just wrap it up. Now you can see the advantages of a lecture tutorial method. If everybody's paying attention, we can cover a lot more ground. Okay. The problem in YTM is that there is an assumption. Now, if you are going to do this, if you're going to look at the YTM, like US 10-year YTM is 1.299, 1.3. Okay. If you're going to look at this and say, and make a statement that, okay, this is one way of looking at YTM, which is that YTM is the discount rate, which is the correct. This is what the YTM is. This is how it is derived. Okay. But that's one thing. YTM assumes the third thing, that interim, that is pre-maturity. So this is the point that Isha was mentioning about the reinvestment rate. Okay, now this statement is true. This is an assumption in the YTM calculation. Why do we say that this is an assumption in the YTM calculation? So what is the assumption? Let me first explain that, and then I'll explain to you why we say that. Okay. Now, sometimes people try to argue that this is not an assumption. No, this is not correct actually. This is an assumption, and I'll tell you why. Okay. So what is the assumption? That interim coupons are reinvested at the YTM percentage. So when we say that the YTM on this bond is here, if we say the YTM on this bond is 3% in this case, we are going to say that because we know that the price is here. They've already given it to us, right? That the market price, the YTM is 3%, and because the market price has been taken as 1037, that is observed in the market. Okay, so what the YTM is now. And so what are we? And so the assumption is that the critical assumption in this calculation is that this first year coupon which comes. Okay, this is a cash gift given to you, right? Now you have to reinvest this cash. So the assumption is that this $40 which comes to you after the end of 1 year can be reinvested from the end of year 1 to the end of year 4, also at the YTM rate, that is 3%. Okay, so which means that after 1 year you have 1, 2, 3 years. So the 3-year reinvestment rate, a 3-year interest rate, okay, on a 3-year investment, after 1 year is going to still be 3%. Similarly, the interest rate for after 2 years, this another second year coupon that comes, this also can be reinvested for till maturity. Okay, and this is now 1 year, second year, the third year, fourth year, 2 years. So this, after 2 years, you should get a 2-year reinvestment option again at 3%. So these are the assumptions. If these assumptions do not hold true, okay, then you will not realize this return, the 3% return on the overall bond holding. That we said that we are going to hold this bond to maturity, right? So this is very important to understand, okay, that all interim pre-maturity coupons are reinvested at the YTM percentage. Has everybody understood this assumption? Yes? Naman,
Yes, sir.
you understood? Yeah, okay. So this is the assumption. Now, why is this why do we say this is an assumption? Because interim pre-maturity coupons are reinvested at the YTM. Okay, let's write this. Otherwise, the total realized return on the bond will not equal the YTM. Okay. Total realized return on the bond, obviously, at maturity. Okay, so even if the principal repayment, there is no credit risk, there is no default. Okay, even then you will not really realize the YTM return at maturity unless you're able to reinvest all the interim pre-maturity coupons at the YTM percentage itself. Okay, now, okay. Yields means prices also. Okay, so yields move in opposite direction to price. Use of YTMs to show debt market yields. Okay, implies well, it doesn't necessarily imply. Okay, is generally taken to imply. That is more correct. It doesn't actually imply, but this is the way that people normally understand it. That you can be an investor, but I just write you. You can realize the ITM if you hold that bond to maturity. You understand what I'm saying here? That is what the mistake that Graham has also made. Yield obtainable on new offering of high-grade bonds. Okay, now he probably looked at 5-year, 10-year bonds. How did he come up with this number? As I said, he would have looked at a YTM table like this and said, oh, okay, 10-year bonds at 1.3%. So that means I can get 1.3% in 10-year bonds. That is only true if you can reinvest all your intervening coupons at 1.3%. There is no guarantee of that. Okay, so that's why this assumption is important to understand, because this is what we assume. 1 minute. 1 minute. I'll just wrap. Okay, I'll just take 2 minutes to wrap up here. Okay, so that's why we say that this is an important assumption, because when we use this to show, you can see that Graham has also made this mistake, that he has said that it is obtainable. It is not really obtainable as such, in the sense that there is no guarantee that you can obtain this. But because it requires you to be able to reinvest everything at 7.3%, let's say for about 10 years, there's no guarantee that that can happen. It may or it may not happen. So that's what you have to understand for YTM. You have to understand, we have spent the whole session on that. But if you can understand the concept clearly, that's still a successful session as far as I'm concerned. Because this is a very important basic concept. You have to be clear about this. What is it? What is YTM? How is it derived? And what do we mean by, that the fact that implicitly, because we use YTMs to show the debt market yields, we are actually making, generally most investors will make the, which Graham has also done, as you saw, they will take this, their take home is that you can realize the YTM if you hold that bond to maturity, but this is not true, and because of assumption 3. Okay, now this, I'll just write this here, this is not true if assumption 3 okay. So this is the point. Why? And sometimes people say this is not a, no, it's actually is an assumption, because the most common use of YTMs is to make a conclusion that you can realize this YTM if you can hold the bond to maturity. So therefore, most of the time we are actually effectively assuming this. So we should be conscious about this assumption number 3. Okay, clear, be clear about this. Okay, all right. So the class is dismissed. I've again taken 2 minutes extra, but hopefully we had a, although we focused only on one topic, but if we can understand this, that's clear. So everybody can leave, and those who have questions can stay back. Yeah, so we had very little coverage today, but still I don't mind actually, as long as we understand clearly what is what we have discussed. Yes, any questions, anyone? How many screens are open? Anyway. All right, no questions, anyone? Okay, so we'll end it here then. I'll stop the recording.